Hello friends, last week in my video, I discussed how the banking sector could potentially bring the markets down, and I followed it up with my weekly live mint article giving you a lot of statistical data, which is our forte, and we share data with you like no one else does in the public domain. In this week's video, I want to talk to you about whether the bulls and especially the HNIs, the ultra high net worth individuals and high net worth individuals are running away from risk and safeguarding themselves. So let's dive right in, and on your screen right now is the market roundup window which tells you, hey, it was bank Nifty which led the way down. The US dollar index continued its upward trajectory that exerted downward pressure on emerging markets including India as well as commodities like gold and silver, which saw sharp declines. Now, the worrying aspect is that energy prices went up. While crude went up a little over 0.5%, natural gas shot up 14%. Part of it, of course, is cost of carry from February to the March futures. The US dollar rose against the Indian rupee, not too much, but 3 basis points. The fact remains that the Indian rupee is a little weaker. 10-year benchmark bond yields are at 7.42%. Now, this is something I told you. We are at the highest point in a couple of months, and that is noteworthy. I've followed it up with a lot of detailed write-ups on my free Telegram channel. I share my thoughts very liberally with my online family. Do make it a point to join this free channel. NSE market cap fell a little over 2.5%. And the MWPL fell, which is routine after the expiry of a monthly series. The US markets provided headwinds and resistance to the domestic markets. Coming to our in-house indicators right now, let's see the MWPL or market-wide position limits indicator. The post-expiry decline is lower than the January futures decline. That tells you that risk appetite has contracted. Not very surprising because there is a little bit of worry and nervousness in the market. So this is the first tiny red flag in the market. Now for the next indicator, the stock and futures turnover. Remember, this is a cumulative figure of March, April and May futures. Turnover has jumped. Part of it you could attribute to the expiry because there is rollover from February to March, so there is duality in turnover recording. But the fact remains that the turnover has logged very sharp gains in a week when markets have recorded losses. So this is the second mild red flag. Now for the advanced decline ratio, what we are seeing is this weekly average advanced decline ratio is now at a month and a quarter low at 0.57, which means for every 57 gainers, there are 100 losers. This is not exactly very convincing. One Marshmallow traders are showing very poor buying conviction, especially since the Nifty has logged 2.67% decline in a week, which is the lowest in the 20-week period. So that tells you that we basically need some very heavy duty follow-up buying, failing which the market might just go down a little more in the coming week. This is the third red flag. Now for the basis. The basis is nothing but the premium or discount prevalent in futures versus the spot. What you are seeing is a sharp rise in the basis, which is routine after expiry because the new derivative cycle offers 4 complete weeks to the players and they are therefore willing to pay a higher premium to trade in those contracts. But over a period of time, the basis tends to fall, and I feel the current levels may just prove to be unsustainable. Not just the time decay, but even selling at higher levels might just shave off the sharp premiums, especially in the bank Nifty that you're seeing. 263 points being unsustainable. Now, friends, for our in-house indicator, the impetus which you will not find anywhere in the public domain on the internet. Now, the worrying aspect. Last week, we saw substantial losses in the headline indices, both headline indices. The impetus reading has risen sharply in both the indices, particularly on the Bank Nifty, which incidentally happened to fall more than the Nifty 50, which tells you, and this indicator is all about measuring force, which tells you that the selling was pretty forceful. This is the fourth red flag, and this one is not a mild red flag. So I would worry about forceful selling. If it is countered by forceful buying in the coming week, hey, all is well. But barring that, this is a fourth red flag. Now for another in-house exclusive indicator you won't find anywhere on the internet, the lift weight thrust drag, LWTD indicator. The tutorials to interpreting the LWTD indicator are in the description below the video as in the pinned comment. So please do apprise yourself with what is meant by this indicator. This tells you that the Nifty, which is indicated by the blue line, has lost the most in a week, in a 20-week period, and the LWTD has fallen below the zero line. That tells you that fresh follow-up buying support is likely to be pretty weak, pretty mild and tepid. So short covering, fine. It's been cushioning declines for this long because the basis has not turned into negative. Fresh buying might just be pretty sluggish or very limited because fear is ruling high. This is a mild red flag, but a fifth one nevertheless. Friends, I now come to the bond market, and the crux of this video is whether the big money, the smart money, HNIs, ultra high net worth HNIs are running away from risk. Look at the chart on your screen. This is nothing but the Indian 10-year benchmark bond yield superimposed with the Indian 30-year bond yield. The 30-year bond yield is inverted or trading below the 10-year benchmark bond yield. Why is it inverted? Because the price of the bond is high. Therefore, the yield is smaller. That means the big money is preferring to lock in the rates for the next 30 years in bond markets, which are absolutely safe because these are government bonds. The government can always print money to repay the bondholders whenever it wants, which is something that private bond issuers cannot do. If the ultra high net worth and high net worth individuals are locking in rates for 30-year bond tenures, they are very, very clearly running away from risk. Do I think they are running away from risk? Yes, I think they are running away from risk. So this is another major red flag, the sixth one in total. And I would keep watching the bond markets very, very closely. Keep your ear to the ground. I've written very detailed articles on my Telegram channel. It's a free channel. Please make it a point to join this channel. We put in a lot of data for traders, for investors. I share a lot of opinions liberally. The fact that I don't charge you anything for advisory services makes it very impartial. Moving forward, friends, I come now to the Bank Nifty, which faced the brunt of the selling, and this index has fallen on 4 out of 5 trading sessions. As you can see on the daily chart on your screen, it's recorded 2.97% losses. The price is below its month-long moving average, and that tells you that the bulls are very, very clearly under pressure. They are facing mark-to-market losses, and the 41,840 level, which I talked to you since the last many weeks as a level that must be overcome if the bulls are to have a chance, still remains unsurpassed. Moving on to the weekly chart, the price has now turned below its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. The average itself is turning lower. So the phase of mean reversion, where the price, which is higher than the moving average, comes to touch the moving average and bounces, or the price goes sideways and the moving average catches up with the price and the price bounces. So that mean reversion phase is over. A corrective phase has begun. If the price remains below the moving average and the moving average also starts falling, then even a bearish phase might begin. So these are not really very great times. Let's watch the 38,750 level keenly. If the bank nifty starts to trade below it, I would say the bulls are in for a little bit of a tough time. In the week before last, this index was at number 8 on our in-house list of highest statistical beta counters, which is volatility. It has risen 4 notches and placed itself at number 4, which is a challenge because higher the volatility, the more is the challenge to an average retail trader. So volatility is definitely going to spike up from here onwards. Last week, I advocated a range between 42,600 on the upside and 39,675 on the downside, which admittedly the index breached because the low it made was 39,600, which is 75 points below where I expected a support at. I also warned you last week that the ranges might be surpassed in either direction because last week's range was fairly compressed. So we were off by 75 points. In the coming week, I expect a range between 41,375 on the upside and 38,400 on the downside. I continue to advocate caution, play it very safe, and let's not take excessive risk out here. Friends, I now go to the Nifty 50, which fell 2.67%. It fell on all 5 out of 5 trading sessions of the week, as you can see on the daily chart on your screen. The price is below its month-long moving average. The average itself is pointing downwards. So the short-term outlook is under pressure. The 18,115 swing high, which I have marked with a bold blue trend line, still remains a very formidable resistance, a hurdle, and unless the bulls overcome 18,115 levels, I would say fresh buying is off. Will the support provided by the bold red trend line, which connects the peaks starting from October 2021 and thereafter, will it hold? Time will tell. It's close to 17,250 odd levels. The coming week will let us know. Now moving towards the weekly chart, here again, the candle is a power candle, a fairly large size candle, and it's closed below its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. The average is not turning as sharply downwards as in the case of Bank Nifty, but that needs watching. Let's see the 17,200 levels for guidance here. In the week before last, this index was at number 19 on the most volatile counters list. It has shot up by 11 notches to number 8. Now that's a very, very sharp rise in statistical beta, which is pure intraday price volatility. I can imagine if my online family members and friends are telling me, hey Vijay, it's become tough to trade and make money at the same time because your statistical beta is rising. Last week, I advocated a range between 18,425 on the upside and 17,475 on the downside. Here again, the support was breached by 53 points because the low it made was at 17,422. But like I said, the previous week's range was fairly narrow due to a low base effect. And I had warned my online family that the range could be breached in either direction. So we were off by 53 points. In the coming week, I expect a range between 17,950 on the upside and 16,975 on the downside. Here again, let's be careful out there and let's trade light. Friends, I now come to the last bit of statistical analysis wherein we gauge the footprint of the fear or the greed of an average retail trader by taking a screenshot of his footprint in the digital sands of the market. On your screen right now is a daily chart of the component turnover logged by various instruments. The sky blue line is the stock options. On a week-on-week basis, the turnover contributed to the entire NSE FNO turnover by stock options has been lower. Stock futures is the olive green line. Here again, the turnover is lower compared to the previous week. That tells you that aggression or risk appetite has definitely contracted because stocks are more volatile than indices, and when traders are going in for indices, they are showing lesser risk appetite. Index futures turnover, I would say it was more or less equal to the prior week. Now let's see what index options have done. Very clearly, the index options turnover has taken the lion's share of the FNO turnover last week. Now, index options are the lowest risk instrument out there. And the fact that retail traders were playing the lowest risk instrument tells you, hey, risk appetite is clearly on the ropes. It's really, really down. I would go to the extent of saying that there is fear in the markets. For me, as a statistical trader, a systems trader, this is the sixth red flag. And here again, it's not a mild one. It's a fairly prominent red flag. I now come to the special segment that I've started sharing with you about what I would do in the coming week. I've shared with you my view that I foresee trouble for interest rate sensitive sectors, all sectors that are dependent on EMI based sales, because coupon rates or interest rates are rising and the cost of funds is going to hit a lot of people. I'm not talking of traders, I'm talking of day-to-day average citizens. Coupon rate rises are going to hit a lot of people in the gut. So I'll continue to try and capitalize on theta decay in the option space on interest rate sensitives. I'm seeking out for select short opportunities in some select cyclical counters, and I will also seek short opportunities in the commodities space, in the energy space on advances. I would not go out there and blanket short at any level possible. It's not that you short in the morning and cover it late night. That's when the market ends. But it would have to be very, very price selective, because I think there is short covering happening, especially in natural gas at lower levels and in select pockets of price bands in crude oil. So one has to be very savvy, very nimble footed out there to make money. Friends, I now come to the most popular segment of this video for statistically minded traders, wherein I share names of 5 stocks that have gained the most amount of impetus on Friday, where you take big exposure, wait for small price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These are for scalpers. Remember, this list is valid only for Monday. If you wish to be updated about this list Tuesday through Friday, please join my free Telegram channel. So here goes. The list of impetus gainers is led by Gas Authority of India Limited, followed by HPCL, Hindustan Petroleum, and then Ashok Leyland at number 3, number 4 IRCTC, and number 5 Indian Oil Corporation. Impetus losers list is led by Lupin, number 2 Balakrishna Industries, number 3 IDFC, number 4 UBL, and number 5 City Union Bank. Before I wind up this video, a reminder. Please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about what videos are being put up out here, fresh videos being put up out here. And hey, I'd love to hear from you about how my videos are helping you become better traders. And do let me know in the comment section what you think of our work. Also, help me reach out to smart traders and investors like yourselves by sharing my video with your online friends and family. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.